Welcome back to the Financial Freedom Show. My name is Rob Berger. Today, we're going to talk about the three types of investors and trying to help you figure out what type of investor you are. I think every type of investing, every type of investment can be categorized in just one of three ways. The issue came up for a couple of reasons. The first thing is one person reached out to me and wanted to know whether she should start investing today. She plans to invest money in sort of a broad-based group of index funds, but she recognizes that the market is a bit frothy right now, and so she's a little nervous. Should I do it now, or should I wait until things settle down and maybe the market drops a little bit? And that was a great question. In fact, it's a question I faced, almost 3 years ago in early 2018 when I sold DoorWorlder.net. All of a sudden, I had all this money to invest. Now, some funny thing was back then I was worried about the very same thing. The market just seemed crazy expensive, and I wasn't sure if I should just put it all in mutual funds. Now, it turns out that that's what I did, and we'll talk about why in today's video. But part of my reasoning came down to just recognizing and understanding the type of investor that I am and sort of sticking to those principles. The other reason it's come up is because there are a lot of investments right now that are doing extremely well. In fact, take a look here. This is the price of Bitcoin. I just did a Bitcoin video just the other day about how I don't personally think it's a great investment, but regardless, here are some things to think about. And it's already since then gone up significantly. I mean, it's doubled in the course of a month. Today, as I record this video in early January 2021, it's at over $41,000. And that raises the question, well, shouldn't we all be plowing our money into Bitcoin? And so in today's video, we're going to walk through the three types of investors, the pros and cons of each, and some thoughts to think about as you kind of figure out where you are amongst these three options. Now, keep one thing in mind. It's not all or nothing. I actually fall into two of these three categories, as I'll explain, and you may too. I mean, I guess some folks might take all three approaches. So with that, let's get to it. So the first type of investor is what I just call the market investor. You're not trying to pick individual stocks. You're not trying to time anything. You just want to cover the whole market. And for most of us, I think we use mutual funds or ETFs to do that. I think a lot of us, myself included, use index funds. You don't have to. You could take this approach with actively managed funds as well. And it's pretty common inside of 401ks and other workplace retirement accounts. So again, you're not trying to predict anything. You're not trying to guess the future. You're just saying, look, I'm going to put some money in US companies, maybe including small cap. I'm going to put money in a fund that covers international companies, maybe emerging markets, maybe REITs, real estate funds. And I'm just going to invest that way probably every month, going to do dollar cost averaging, maybe not even so much as a strategy, but simply because that's pretty much how we invest in a 401k, right? We take money out of each paycheck and in it goes. And that's just sort of our approach. We don't need to read a whole bunch of stuff if we don't want to. We don't have to read a company's 10K or 10Q. We don't have to even follow the market for that matter. We can just go out and throw the frisbee, as I like to say. Well, that's what I like to do when the market's crashing. Just go play some frisbee. It's not really what I do, but anyway. And it's pretty easy. I think anyone can do it. It's not complicated. It can be a little intimidating. That's certainly true when we have events like this past year, 2020, when COVID hit and the market just tanked. It can be unnerving. It's like, what should I do? And the answer, I think, is nothing. You shouldn't do anything. But that can be very, very hard to do, as we all know. But that's the first kind of investing. Now, if you take that approach, and I would say about 85% of our portfolio is buy and hold index funds, my view is you should just keep investing regardless of what the market is doing. Sometimes it's going to be extremely high, like it is today. And in fact, let me just show you how high it is. We're looking at the S&P 500, the price to earnings ratio. This is from the Shiller website. And you can see it's a little red dot on the far right, 38.33. Now, you can look up the PE of the S&P 500. You might get slightly different answers depending on how it's calculated, but I think this is good enough for our purposes. And you can see, other than this weird blip right before 2010, if we kind of ignore that, which was short-lived and a bit of an anomaly, we're at the second highest level ever. The only one that was slightly higher was right before the tech bubble crashed. So we are in nosebleed territory. And as I record this video, here are the stock market futures. It looks like the market's going up again more today. And I'm sure Tesla will add who knows how many quadrillion of dollars of market cap today. But the reality is, yeah, things are very expensive. And so I think it's a fair question to ask, should I wait? The reason I wouldn't wait, there's probably two good reasons why I personally wouldn't wait. And by the way, I didn't wait in 2018 when I had a lump sum amount to invest. But there are two reasons. The first is I don't know when I'm going to wait until. At what price do I decide, okay, now I'm getting in? I mean, I suppose I could set some arbitrary standard looking at the PE again. I could say, well, it's 38 now. I'm going to get in when it's 20. But who knows when that's going to be? And just because the markets are expensive doesn't mean they won't go up even higher. So the problem I have, the first problem is if I'm going to wait, I don't know how to put some sort of defined period of time around that, or to have some sort of threshold. I'll invest when it's this valuation. That's the first problem. The second is not so much a problem, but a reality. My buy and hold portfolio is not just the S&P 500. I have money in small cap. I have money in developed markets, so that's outside the U.S., in developed economies, think Germany, for example. I have money in an emerging market index fund, and I have money in a REIT index fund. That's sort of my general approach. And then, of course, I have some bond funds. My point, though, is that the PE of my portfolio is not 38.33. I haven't looked it up in a bit, and I could do that. But in fact, hold on. I'm going to pause the video and go look it up. Okay, I'm back. So the PE of my portfolio is around 20-ish. Now, the way I calculate that is I use Morningstar. Of course, I've done a whole series on Morningstar. Actually, my go-to tool is Personal Capital. That's what I use every single day, in part because Morningstar requires a lot of effort and a lot of input to keep your portfolio up to date. But I have one in there that I set up a while ago, and a quick glance at it shows me that the PE is around 20. The forward PE, in other words, based on the estimate of future earnings over the next 12 months, puts it around 18 and a half. So that's the second thing. If you have a well-diversified portfolio, again, the markets may still be expensive based on historical standards, but it doesn't mean that they're at 38. Now, of course, having said all of that, you still have to deal with reality. You could invest lump sum now in, a portfolio of index or even actively managed funds, and the market could drop. In fact, I expect the market to crash. I just don't know when, right? So what can you do about that? Well, one approach is just to say, yeah, it's going to happen. But look, I'm investing not for the next year or two, but for the next 20 or 30 or 40 years. And there's going to be a lot of ups and downs over that time. And I'm going to roll with the punches. Another approach would be to take, say, a lump sum and invest it over 12 months, for example. Now, if you look at studies, they will tell you the better approach is to put it all in at one time. But the reason for that is because when you look back at, say, the last 100 years, most markets are up more years than they're down. So if you're just playing the odds, it's more likely that putting the money in, say, in January is going to end up with a better outcome than if you spread it out over 12 months. The thing that a lot of those studies, though, don't account for is the market valuations in January. And my hunch is, unburdened by any actual studies, because I've looked for them, I can't find them, is that if you looked at Januaries where the market valuations, say on a PE basis, were really expensive, say the top 20 or 25%, I'm not so sure the lump sum investing would actually win out. I suspect it might be a much closer call, or even it might be better to spread the investments out over 12 months. The point is, a lot of this has as much to do with sort of psychological and behavioral finance as it does math. So if you've got a lump sum to invest, you've decided you're this first type of investor that I've talked about, the market investor, but you're a little nervous about the valuations right now, and you think, maybe I'll just spread it out over 12 months. I think that's a perfectly reasonable approach. It may or may not end up being the best approach. You may have been better off putting it all in right now, but of course, there's just no way we can know ahead of time. All right, so that's the first investor. I'm guessing it's many of you follow that approach, at least if not completely, to a large extent. And frankly, I think it's the best approach for the vast majority of investors, myself included. And by the way, so does Warren Buffett. He said the very same thing. He said not only should individuals basically just buy the market and in fact use index funds, he says most institutions should do the same thing as well. So that's the first type. All right. The second type is what I would call a value investor. So what does a value investor do? Well, he or she goes in and analyzes individual companies and looks at their financial statements, their annual reports, their quarterly reports, listens to earnings calls to hear what the CEO and the CFO have to say about the company. They study the industry. And what they're looking for is they're looking to buy companies that are selling at or below what's called the intrinsic value of the company. In other words, the value of the company that's justified based on its expected future earnings and cash flows, right? And that's what Warren Buffett is. He's a value investor. Charlie Munger is a value investor. Guy Spear, who wrote The Education of a Value Investor, I had him on my podcast several years ago. Great guy. He's a value investor. And to some extent, I'm a value investor, or at least I do my best to be a value investor. It's not easy figuring out these financial statements. So 15% of my portfolio is in individual companies, and it turns out it's only in 3. So I guess I would also be called a focused investor. I'm not spreading my 15% over 30 companies. I don't see the point in that. I could just put it all in an index fund. So I own Apple, Berkshire, and Bank of America. Those are the 3 companies I own. I've owned Apple the longest, since 2013. Bank of America, I've owned for the least amount of time. I took that position in October. And so that's a value investor. Now, it takes a lot of work. It takes a lot more work than just putting your money in an index fund or a group of index funds. I enjoy it. I enjoy the analysis. I don't, so far my results have been very good, but I sort of recognize that some of that is just luck, if I'm being totally honest. And, in 10 or 20 years, I'll let you know how it all went. I mean, I've been investing this way since I said 2013. Yeah, that's 7, 8 years. That's not really a long time. I mean, it may seem like a long time, but it's not. When you look at someone like Warren Buffett, and he's been doing this for 50, 60, I guess 60 years, that's a long time. Okay. And no, I'm not comparing myself to Warren Buffett. So that's the second type. That's a value investor. Now, the interesting thing about that is if you say, yes, I'm a value investor, you will not invest in Tesla. I know it's been up a gazillion fold in the last 12 months, but it is not a value stock. Its current PE is around 1,400. That's amazing. What that means in practical terms is that at the company's current earnings, it would take until the year roughly 3,400 for you to earn back your money. Now, that doesn't mean Tesla stock won't go up even higher. What it does mean is that it's trading at a value that cannot be justified based on a fundamental analysis of the company's performance. Right? And so a value investor I don't even need to analyze the financial statements. I mean, I might read them just out of interest, and it's certainly a very important industry. But Warren Buffett doesn't have to read Tesla's 10K to decide whether or not he wants to invest in it. It's just not going to happen. Okay. And so that actually brings us to the third and final type of investor. It's what I call a price investor. Some would call this category speculation, and I think that's actually fair. I don't say that in some sort of derogatory way, but it really requires a lot of good luck. But I prefer price investor, and here's what I mean. And we'll use Bitcoin since it's the hot commodity right now. The one and only way you can make money investing in Bitcoin is if other people are willing to pay more than you pay to buy it from you. It's the only way, right? There's nothing underlying it. It doesn't do anything. There's no underlying cash flow. Now, I don't say that. I know Bitcoin bulls are like, they go crazy over this stuff. I'm not here to say bad things about Bitcoin. If you're going to invest in it, though, you need to understand that, right? It's kind of like gold. Gold doesn't do anything. You dig it up in the ground in Africa, you ship it over to the United States, you bury it in the ground, and it sits there, right? That's what it does. And so there's no underlying cash flow to evaluate. It doesn't generate cash flow. And so if you're going to invest in that sort of thing, you are a price investor. Now, As we know, price investors can become extremely wealthy in an extremely short period of time. There's stories now about the Tesla millionaires. Now, obviously, Tesla is different than gold and Bitcoin. There is something underlying that stock. There is a real business, and from what I can tell, a very good business. And it's generating cash flow. It's actually making a profit. Investing in Tesla, though, would still fall into the price category because it's so divorced from those underlying fundamentals, right? So people can make a fortune. They've made a fortune in Tesla. They've made a fortune in Bitcoin. But price investors can also lose a fortune very, very quickly. Now, I believe that eventually all of the frenzy of the market that we're seeing right now, and I'm recording this in early January 2021, will evaporate, right? Bitcoin will go down. It's gone, it's lost 80% of its value twice already. It will happen again. And I don't know that it'll be 80%, and I don't know when, but it's going to happen. Tesla, it's going to happen. And why do I believe that? Because it's always happened. Never in the history of the world has an investment that's become so divorced, if it has any underlying fundamentals, divorced from those underlying fundamentals, just continue to go up forever. So I suppose one could argue that maybe Tesla is different or maybe Bitcoin is different. I don't think so. I guess time will tell. But the real important thing is to understand you're a price investor. And you can get rich quick, you can get poor quick as well. Another example would be options trading. And I know that's sort of the big thing now as well. I see a lot of folks talking about selling covered calls. If you're not familiar with a call, you let's say you own 100 shares of Apple, just use a stock that I own. I could sell a covered call on that, be one options contract. And let's just assume Apple's, I think, trading at 130. So let's assume I sell a call. What I do is I give someone the right but not the obligation, that is, they can if they want to, but they don't have to buy my 100 shares from me at some agreed upon price. And they call it the strike price. So let's say it's 140. So it's trading at 130. I sell a covered call with a strike price of 140. And all calls, all options expire. And there's different time periods. Well, let's say it expires in 30 days. So whoever I sell this to, he or she can buy my shares trading at 130, but they got to pay $140 for it. And they got to do it in the next 30 days. Now, I get a premium, and I get to keep it, right? No matter what happens, I keep that premium. Good for me. And then we sit and we watch. What do? Do we analyze the underlying fundamentals of Apple? No. We stare at the price. It's the only thing that matters. And more specifically, what that price will do over the next 30 days. If it stays under 140, I'm the big winner, right? I don't have to sell my shares. I keep the premium they had to pay, and good for me. If it goes above 140 and they exercise the option, I could be a big loser. Depends on how much above 140 it goes. Let's say it jumps to 160. I'm going to be really upset that I sold that covered call. I can say, well, I made the extra $10 between the 130 trading price when I sold and the 140 strike price, and I kept the premium, but that doesn't make up for the extra $20 beyond that I lost. So options trading is very much price investing, and that's particularly true for the much shorter options. So those are the three kinds of investors. And I think it's important for you to understand and decide what kind of investor you are, and then to decide, the pros and cons of that and how you should think about your investments. I personally believe that price investing is not a recipe for long-term success. I've been looking a lot at ARK, which has some really high-flying ETFs or mutual funds that are very much price investing. Now, that's not to say they don't do a lot of analysis of the companies they invest in, but I was looking specifically at one fund, and their top 10 holdings, except for one or two companies, they all lose money. And so there is no history or existing cash flow to analyze to really have a good sense as to the intrinsic value of these companies. However, they've made a fortune lately investing in companies like Tesla. The question is, when will it end? And when the music stops, when the tide goes out, as Warren Buffett likes to say, what's it going to look like for these types of investors? I can go back in time to Legg Mason Value Trust, run by famed investor Bill Miller, who, by the way, phenomenal investor. And his fund beat the S&P 500 for 15 years. That's a phenomenal record. But then it didn't, and it went down quickly. And I fear that that's going to happen to a lot of investors who are sort of getting carried away right now with values and prices that just seem to go up and up and up. So those are the three types of investors. I'm 85% buy and hold index fund, invest in the market. I'm 15% value investor. I'm 0% price investor, which means, and this is the hardest part, I have to get comfortable with the fear of missing out. I have to be comfortable that I'm not investing in Bitcoin, that I didn't invest in Tesla. And I'm very comfortable with that. But for a lot of folks, that's extremely difficult to do. You sit, particularly, by the way, when you've got a coworker who wants to tell you that he bought Bitcoin in 2014 and he's retiring and he's a quadrillionaire. It can work out for some people. It won't work out for many, many more. All right, so those are the three types of investors. What type of investor are you? Leave that in the comments. Feel free to disagree with me. The pros and cons, just please be kind in the comments. And hope you have a great day. Again, if you have any questions, leave those in the comments. I'll do my best to help you out. And until next time, remember, the best thing money can buy is financial freedom.